If we look at land registry data, we can see that property prices in the UK have doubled every 7 to 10 years. But this is not the case for all properties. Some areas have risen even more dramatic than that, and some areas have even went down. What areas are the best to invest in? How do I pick, and how do I know? In this video, we're going to cover that. Hey, it's Gary from Let Property, and we help thousands of investors every single year buy and sell their investment properties through the sale of specialist tenanted properties. I personally own a multiple seven-figure property portfolio, and I'm here today to help investors just like you invest in properties in a hands-off way exactly like I did. As the guy who runs a company that has literally helped thousands of investors across the country buy into almost every area in the UK, what areas should we be looking at, and is there areas that we should be looking to buy, and is there areas we should be looking to sell? Let's cover that just now. So I do believe for any investor, one of the most important rules to try and stick by is to buy in one particular area or a couple of particular areas. We shouldn't be trying to invest in multiple properties and multiple lots of cities all across the UK. That's a silly move. So the reason for that is very, very simple. You actually get a bit of an edge as you invest in one area because you learn a market, you learn what the rents are, you learn what the prices are, and you can effectively do better deals by just being more aware of this particular market. It's like any skill in the world. The other thing to consider is that properties need to be managed, and if you have a great relationship with a letting agent in one location, it's a lot easier for you to actually run that portfolio. So if you're going to be buying 10 properties, I would not recommend doing 10 cities. I would recommend doing 1 or 2 cities and working with a couple of people on the ground who can handle those properties for you so that you can have a hands-off investing experience and achieve results that way. Now, the thing is, there isn't just like one hotspot, one place that's amazing. There's so many good places, and there's so many bad places. But in this video, what we're going to talk about is we're going to talk about the characteristics of good places, the characteristics of bad places, and actually give you a sort of financial model as to how you can actually come at each area to know if it's good or bad at any different point in time. Like, very simply, a bad area is an area that's risen very recently and it has no more growth in it, right? Like, we want to be buying stuff that has the opportunity. And if you're talking about the complete, like, king areas of property, it's a lot of the areas that are actually underdeveloped just now but have massive potential to be developed. Like, one thing that your sort of institutional level investors will be looking at is they'll be looking at areas where there's a lot of growth happening in the area. So there's maybe new motorways being added, there's new shopping centres being added, there's a lot of amenities being added to particular areas, but the property prices are actually really low. But in maybe 5-10 years, there's going to be a lot of residential living interest in that area because of all the amenities that have been added around it. So that's one of the sort of key ways that the sort of property prices grow exponentially in particular areas. Now, there's really just 2 balancing wheels that we really need to look at in any area, and it's really 2 metrics that we want to be looking at the average data of. And this is how we can really compare an area like Manchester to Glasgow or Glasgow to London. We can actually just look at 2 key metrics. So the first metric is yield. That is effectively the income that the property produces. Yield is calculated by the monthly rent times out by the year. So take the monthly rent, times it by 12, and divide that number by the price of the property or the valuation of the property. And that works out the yield of the property. Now, yields from the UK are going to vary place to place. You're going to have places like London where the average yield sits at around 5%. And if you go into Manchester or Glasgow, you're going to have much higher yields. It's 7%. The other factor on this side to look at is capital growth. Capital growth is the opposing argument to yield. That is effectively the value of the property. So although London has lower yields of 4 or 5%, the capital growth rate in London over the last 10 years has been about 13%. If we look at areas like Manchester, the capital growth rate has only been 7%, and the yield base is around 7% too. So Manchester actually has a higher yield, but it has a lower capital growth rate. So what we tend to find is the average yields and average capital growth rate tend to go in a tipping scale. If we're in a place where the yield is higher, the capital growth rate in that area will tend to be lower on average. And if we do it the other way around, if the capital growth rate is higher, the yield will tend to be lower. And London is the extreme example of that. London is an area that over the last few years has grown faster than anywhere else in the UK, but the yields remain low because effectively the rental rates haven't caught up with the prices of the property in that area. So like if we're comparing 2 areas together, what we really want to be looking at is we want to be finding out the sort of what the expectations are of that area. Like, are we likely to, like, what have we seen in terms of capital growth rate recently? And what have we seen in terms of yields that you can buy on properties today? What's the numbers? And then let's compare that against another area. And this sort of gives us a financial back-to-back model as to how to analyze an area. because ultimately the only way we make money on property is either from the income it produces or from the growth of the asset itself. And if we can compare the percentage rates of growth or the percentage of income versus the value, that's the sort of model as to how we can look at how good an area is as compared to another area. So like obviously I'm being very specific about like cities. Like we can go even deeper than this and start to look at parts within cities, because within Manchester there's about 50 locations that you can actually look to buy within Manchester, and some of those areas are good and some of those areas are bad. So what we really need to do to really narrow this in is to find sort of gold mine locations within particular cities or within particular areas that we want to focus our investing efforts in. And again, the way that we get the data to sort of work out what the average yields are, the average capital rates are, we effectively can look on the open market for reporters like Rightmove. We can just do lots of Google searches. We can look in land registry data. We can sort of figure out what property prices have been worth in that area from 3, 5, 10 years ago, and then work out exactly what the income would be on the property versus the value. And that's how we work out the capital growth rates and the yield basis of properties. Like as I was saying, I was talking about Manchester and Glasgow having an average growth rate of around 7%. There was a property in East Kilbride, which is just south of Glasgow, that I purchased about 3 or 4 years ago, and that property has risen 40% since the time that I purchased it. So there definitely is higher growth locations even in Glasgow, but some areas in Glasgow have not risen at all. Some areas have risen a lot, and the average sits at 7%. So that's why we actually have to look at the individual cases of each property and what's going on around it to really try and get a picture to see if something's actually going to grow over the long term. One of the best ways of knowing this too is to really just start to network. Like as you come into the world of buying property, we work with thousands of investors every year that are coming to us and buying lots of properties from us. Many of those investors will even ask for advice. We sort of see on the sales side what areas are really popping off, what areas are getting high demand, because we're in the seat of actually selling the properties out the door. Right? So we can sort of see the up and coming areas and up and coming locations. So speaking to people dealing with that on an everyday basis can massively help you influence the area that you're going to actually invest in. The one thing that I think is really important to consider too is please don't overthink this. It's not like we're going to find some gold mine, Goldilocks area and time the market perfectly. Like the greatest quote I think you really need to follow when it comes to property investing is it's not timing the market, it's time in the market. And I would much rather you were to buy in an area that was decent and hold a property for 5 years than wait 5 years to buy something in the best area in the world. Because I can guarantee that if you just get started and actually pick something, go for it, have a look at this data, just go for something straight away, you're going to be much better over 5 years just having invested in something that was average versus waiting for that perfect gold mine thing to come up, which never does. So I hope this video was useful in helping you decide what kind of area you might invest in if you're coming in to be a property investor. One thing to finally add is that you don't need to be near the location where you buy the property as well. So many of the properties I own are down south. They're not even in Scotland where I live because I don't manage the properties. I have a letting agent that deals with the properties. So we don't need to actually be in the world of property where the property actually is. We're just looking to find the right locations to invest in. I recently shot a video on where to find the best property investment deals. You can click the link up here to check that one out too.